All right, let's jump right into this explainer. Today, we're stepping directly into the shoes of a professional equity analyst to uncover the true intrinsic value of XBIO. We aren't just skimming the surface here. We're running a full masterclass in stock valuation. We'll extract the raw data directly from the filings, lay out our assumptions, and run this company through absolute, relative, and asset-based models to calculate a definitive value per share. If you've ever wondered how Wall Street actually prices a highly complex, cash-burning microcap, well, you're in exactly the right place. To do this right, we've got a strict game plan. We'll hit the XBO mystery, absolute models, relative valuation, asset-based valuation, and finally, our overall verdict. Let's kick off with Section 1, the XBO valuation mystery. Right now, the stock is trading at exactly $2.97 a share.
Check out these baseline numbers pulled straight from the filings. We're dealing with a tiny market cap of just under $7 million. On the top line, things look genuinely exciting, a solid 3-year revenue compound annual growth rate of over 20%. But man, you look further down the income statement and it's an absolute bloodbath. XBO has a severely negative net profit margin of negative 125%, and their trailing free cash flow is a staggering negative $2.28 million. I mean, that is a breathtaking pace to burn through cash.
So here's the critical question we have to answer. How do you value a company that's bleeding over $2 million in free cash flow? Traditional valuation relies heavily on steady profits, but with a historical earnings yield of negative 38%, XBIO looks completely worthless if you only look at earnings. We need models built for severe distress. And this is exactly why analysts need multiple tools in their toolkit. Your standard dividend discount model? Completely useless here. XBIO's dividend growth is exactly 0. With that kind of cash burn, they certainly aren't writing dividend checks anytime soon. So we're forced to pivot to our other absolute models, discounted cash flow and residual income.
That brings us right into Section 2, absolute models, specifically the DCF and DDM. For discounted cash flow, we need to project free cash flows and discount them back to today. But since the source filings only give us that historical negative $2.28 million and 0 future projections from management, we have to make some sensible standard assumptions. Step 1, we assume a really challenging 5-year turnaround path just to break even. Step 2, we apply a high 12% discount rate to heavily penalize the valuation for the massive risk of being a cash-burning microcap. Step 3, we add a highly conservative 2% terminal growth rate. And step 4, we calculate the present value. When you crunch those numbers, the mathematical reality is pretty harsh. That near-term cash burn severely drags down the firm's present value. Our DCF spits out a highly fragile intrinsic value of roughly $1.50 per share. Since the bulk of this value relies on assumptions years into the future, while the near term is deeply negative, this result is just way too sensitive to be reliable on its own. Because that DCF is so fragile, we've got to test a second absolute model, the residual income model. This is actually a brilliant little hack for companies with negative cash flow because it anchors to the existing balance sheet, specifically the current book value of equity. Then it just adds the present value of future residual income, which is basically net income minus a required charge for the cost of equity. It's a totally different angle. What's really fascinating here is the impact of XBO's operational efficiency. The data shows their return on equity is a dismal negative 36.25%. Because that return is so much lower than our assumed 12% cost of equity, XBO is actively destroying economic value every single quarter. So the model actually subtracts value away from the starting book value, leaving us with an implied value of around $1.80 per share. So far, both absolute models strongly suggest the stock is overvalued at its current price. Let's move to Section 3, relative valuation and peer multiples. Since projecting the future looks incredibly bleak, let's see what the market is willing to pay right now for similar assets. Normally, analysts jump straight to the PE ratio, right? But XBO's PE is negative, making it totally useless. We also see an EV to EBITDA ratio of 0.34, but with a net margin of negative 125%, earnings multiples are deeply distorted. So we pivot to top-line metrics, price to sales. XBO currently trades at a PS of 2.32. If we look at the broader market and assume a typical microcap biotech peer average of around 3.5, applying that multiple to XBO implies a value of $4.48 per share. Suddenly, looking purely at revenue, XBO seems undervalued. Okay, we've got wildly conflicting signals. Let's move to Section 4, asset-based valuation.
What happens if we ignore the terrifying income statement entirely and look for the absolute floor of the business through net asset value?
The financial metrics reveal a bizarre but crucial reality. XBIO has absolutely zero debt. None. They have massive short-term liquidity, boasting a current and quick ratio of 8.32. That means they have over 8 times more liquid assets than short-term liabilities, and their price-to-book ratio is sitting at 0.92.
To translate that into plain English, a price-to-book ratio under 1 means you are currently paying less for the stock than the theoretical cash you would get if the company just closed up shop, paid off every liability, and liquidated today. Let's do the math backward from the current $2.97 stock price and that 0.92 price-to-book ratio. Doing that gives us a rock-solid net asset value of exactly $3.23 per share. And since there's zero debt, we don't even have to make messy fair market adjustments to liabilities. The balance sheet is pristine. All right, Section 5, synthesis and our final intrinsic value verdict. Let's bring all these threads together. Synthesizing our models reveals some massive discrepancies. The absolute models, the DCF at $1.50 and residual income at $1.80, are absolutely punishing the stock for its cash burn. We have to rate their reliability as low simply because projecting cash flows for a company losing this much money is mostly guesswork. The relative price-to-sales model gives us an optimistic $4.48, but that relies entirely on peer sentiment. But that asset-based NAV at $3.23, we rate that reliability as high purely because of that zero-debt balance sheet. When we compare these valuations side by side, we deem the net asset value the most reliable anchor. It's a highly tangible, mathematical floor against those risky negative cash flows. The market is pricing the stock at $2.97, which is a measurable discount to the actual net assets sitting right there in the company. So, weighing that remarkably strong balance sheet against the terrifying operational cash burn, we arrive at a final blended intrinsic value range of $3 to $3.50 per share. This indicates that at the current market price, XBIO is slightly undervalued. It's trading at a discount to its liquidation value, giving us a rare, though highly speculative, margin of safety. But of course, in equity analysis, math is only half the story. Time is the other. I want to leave you with this final thought. In the high-stakes world of microcaps, is an ironclad, zero-debt balance sheet the ultimate safety net for your investment? Or, given that massive negative cash flow, is it just a slow-burning fuse? Thank you for joining this rigorous explainer. Keep questioning the numbers and keep learning.